very good afternoon, good morning, or good night, or whenever Madam is watching this video. My name is Nur Isabella binti Muhammad Azman, and today my group will be presenting on Chapter 22, Audit of the Capital Acquisition and Repayment Cycle. This is our group members. We consist of 6 people. As for myself, my name is Nur Isabella binti Muhammad Azman, and I'll be your first presenter today. For my part, I'll be talking about the characteristics of the acquisition and repayment cycle. There are 4 characteristics. First of all is relatively few transactions affect the account balances, but each transaction is often highly material. Second is the exclusion or misstatement of a single transaction can be material. Third, a direct relationship exists between the interest and dividends accounts and debt and equity. And fourth, a legal relationship exists between the client entity and the holder of the stock, bond, or similar ownership. In my next slide, I'll be explaining it in more detail. Let's talk about the first characteristics, which is relatively few transactions affect the account balances, but each transaction is often highly material. What does this mean? While this means that while the number of transactions involving bonds is low, each individual transaction has a significant impact on the financial statements, hence highly material, which indicates that this transaction involve large sums of money or otherwise important enough to influence decisions made by users of the financial statements. So when bonds are frequently issued by companies, the amount of bonds is usually large. This statement highlights that companies do not issue bonds very often. However, when they do issue bonds, the value of these bonds is substantial. This aligns with the previous statement as these infrequent transactions involving large amounts are highly material to the company's finances. The size makes it common for auditors as part of verifying the balance sheet accounts to verify each transaction taking place in the cycle for the entire year. Due to the significant amount involved in bond transactions, auditors typically verify each transaction individually. This thorough approach ensures the accuracy and completeness of the financial information related to the bonds in the balance sheet. Since each transaction is material, missing or misstating even a single transaction could significantly impact the financial statements. Audit schedules for most accounts in the cycle include the beginning balance of every account, every transaction that occurred during the year, and ending balance. What does this mean? The audit schedule or audit plan for the accounts that involve bond transaction will detail the starting balance at the beginning of the year, list all transactions that happened during the year, and show the ending balance at the end of the year. This comprehensive approach helps ensure that all transactions are accounted for and that balances are accurate and complete. In summary, for this point, these statements explain that although bonds transactions are rare, they involve large amounts of money, making them highly significant to the company's financial statements. Consequently, auditors must verify each transaction meticulously to ensure the accuracy of the financial statements. The audit procedures for these accounts include a detailed overview of all transactions and balances throughout the year. For my second point, the exclusion or misstatement of a single transaction can be material. This statement provides additional context on the significance of individual transactions and the focus areas for auditors when auditing accounts involving large but infrequent transactions like bonds. The exclusion or misstatement of a single transaction can be material. This means that omitting or inaccurately reporting just one transaction can have a significant effect on the financial statements. In other words, due to the large amount of money involved in each transaction, even one error can materially misstate the financial position or result of the operations of the company. Material here indicates that such an error could influence the decision of users in the financial statements. So, the auditor's primary emphasis in auditing these accounts is often for the completeness and accuracy balance-related audit objectives. What does this mean? Auditors focus mainly on ensuring that all transactions are recorded, hence completeness, and that the record transactions are accurate, hence accuracy. Completeness means verifying that no transactions have been omitted or forgotten, and accuracy means checking that each transaction has been recorded correctly in terms of amount, date, and account classification. For accounts involving infrequent but large transactions, ensuring these objectives are met is crucial because any errors could have a substantial effect on the financial statement. In summary, for this point, these statements emphasize the importance of each transaction in accounts involving significant amounts of money. Auditors prioritize verifying that all transactions are fully and accurately recorded to ensure the financial statements are free from material misstatement. Moving on to the next slide, which is my third point. A legal relationship exists between the client entity and the holder of the stock, bond, or similar ownership. What does this mean? This means that there is a formal legal connection between the family, client entity, and the investors or creditors who hold its stock, bonds, or other ownership instruments. This relationship is governed by legal agreements, regulations, and rights that impact how these financial instruments are handled and reported. In the audit transactions and amounts in the cycle, auditors must take care to make sure that significant legal requirements affecting the financial statements have been met and adequately presented and disclosed in the statement. Auditors need to ensure that all legal obligations and requirements related to these financial instruments are fulfilled. This includes verifying that the company complies with the laws and regulations, such as those related to issuance, recording, and reporting of stock and bonds. Auditors must also ensure that all relevant legal information is properly presented and disclosed in the financial statements. This might include disclosures about the terms of the bonds, the rights of stockholders, and covenants or restrictions and other significant legal details that could affect the understanding of the financial statements by their users. In summary, this statement emphasizes that in auditing financial instruments like stocks and bonds, auditors must be vigilant in ensuring compliance with legal requirements and in making sure that all necessary legal information is accurately presented and disclosed in the financial statement. This helps provide a complete and transparent view of the company's financial position and obligations. And for my fourth point and last for this subtopic is that a direct relationship between the interest and dividends accounts and debt and equity. A direct relationship between the interest and dividend means that the accounts for interest and dividends are directly linked to the company's debt and equity. Interest expense and interest payable are related to interest-bearing debt, such as bonds or loans. Similarly, dividends declared and dividends payable are associated with equity, particularly the ownership interest of shareholders. In the audit of interest-bearing debt, auditors should simultaneously verify the related interest expense and interest payable. When auditors are examining interest-bearing debt, they should also check the related interest expense, which means the cost of borrowing, and interest payable, the amount owed but not yet paid. This is because these accounts are interrelated. The interest expense for the period should match the interest payable unless it has been paid. Verifying them together helps ensure accuracy and completeness of the financial records. This is similar for owner's equity, dividends declared, and dividends payable. Likewise, when auditing owner's equity, auditors should simultaneously verify the dividends declared, which means the dividends announced to be paid to shareholders, and dividends payable, the dividends that have been declared but not yet paid. These accounts are also directly related, as the dividends declared during a period should match the dividends payable unless they have been paid. In summary, This statement explains that auditors need to recognize and verify the direct relationship between certain accounts to ensure accuracy. When auditing interest-bearing debt, auditors should check both the interest expense and the interest payable together. Similarly, when auditing owner's equity, they should verify both the dividends declared and dividends payable together. This approach helps in detecting discrepancies and ensuring that the financial statements accurately reflect the company's obligation and equity distribution. That is all for this part. Moving on to the next presenter. Thank you.
Assalamualaikum, my name is Nurzifan Hanis. For my part, I will explain about accounts in the cycle. The first one is notes payable. A note payable is a liability account in which a borrower records a written promise to repay the lender. When using an accounting for notes payable, the borrower creates a debt by taking a loan from another party and agreeing to repay the lender with interest. The borrower then records this loan as not payable on their balance sheet. Recording a notes payable includes specifying details and terms of the agreement, including the principal amount borrowed, the due date of payment, and the interest. Next is contract payable. Contract payables refers to the amounts a company owes to its supplier or contractors for goods or services that have been received but not yet paid for by the end of the period. When a company made a payment, the company will then debit the contract payables and credit the cash or bank. And if a business manage a large project and relying on the payable report, it may not provide a comprehensive view of all financial obligations and relationship involved. So it is advisable to create a detailed list of all contractors on the project for a comprehensive financial tracking. Next is mortgage payable. Mortgage payable is a liability account on a company's balance sheet that represent the unpaid principal balance of mortgage loan as of the balance sheet date. Mortgage payable is presented on the balance sheet under a long-term liabilities. However, the portion of the principal that is due within the next 12 months from the balance sheet date is classified as current liability. When a mortgage is obtained, the company records the loan amount received as a debit to the cash account and credit to the mortgage payable account. As payments are made, they are typically allocated between interest expense and principal reduction. The interest portion is expense on the income statement, while the principal reduction decrease the mortgage payable balance on the balance sheet. Next is bonds payable. Bonds are a common form of long-term debt used by various entities like corporations, hospitals, and governments to raise capital for a variety of purposes, such as funding a new projects, infrastructure, or covering deficit. By issuing bonds, these entities essentially borrow money from investors and agree to pay them back with interest over a specified period of time. The bonds are typically recorded at fair value on the acquisition date on the balance sheet. Interest expenses appear as non-operating expenses on the income statement and signify the cost incurred from borrowing funds, including bonds, loans, convertible debt, or lines of credit. The calculation involves multiplying the interest rate by the outstanding principal amount of the debt. These expenses showcase the financial burden of borrowing, which reduces the company's profit but is not directly related to its primary business activities. Instead, it illustrates the expenditure necessary for financing operations and investment. Appropriated retained earnings are any unappropriated retained earnings that are specifically not to be used for dividend payments. It is like setting money aside for something special. So when a company generates profits, it can either distribute them to the owner or shareholders as dividends, or retain them to reinvestment in the business. It is a way for the company to be transparent about how it plans to use its monies in the future. Next, treasury shares. Treasury shares are essentially shares that are no longer outstanding and are not held by investors. They are not entitled to receive dividends or have voting rights, and they do not count towards the calculation of earnings per share. Companies may hold treasury shares for various purposes, such as to reissue them to employees as part of stock-based compensation plans, to maintain control over their ownership structure, or to support the market price of their stock. These shares can come from several resources. These shares can come from several resources. Repurchase or buyback. When a company buy back its own shares from the market, those shares become a treasury shares. This process known as a share repurchase or buyback program. Next sources is never issued. Sometimes a company may authorize a certain number of shares but not issue them to the public. So these authorized but unissued shares can also be considered treasury shares. One is dividends declared. Dividends declared refers to the portion of a company's profit that its boards of directors has decided to distribute to shareholders in terms of dividends. When a company earns profit, it has the option to retain those earnings for reinvestment in the business or distribute them to the shareholders as dividends. The record date is the date on which shareholders must be on the company's book in order to receive the declared dividends. Shareholders who own shares as of the record date are entitled to receive the dividends regardless of when they purchase the shares. The next one is cash in bank. Cash in bank refers to the amount of money that a business has deposited in its bank account. It is readily available for use in its operations. It appears on a company's balance sheet under the asset section. Ordinary shares, also called as common shares, are like the basic ownership units in a company. They give shareholders the right to vote on company decisions on a share of the company's profit. But when it comes to getting paid, these shares come last after other types of ownership. It means if there's any money left after paying other shareholders, ordinary shareholders might get some. However, because they are last in line, they are riskier. But they can also go up in value over time and give shareholders a say in how the company is run, which make them an important part of how companies work. for the preference shares, unlike the ordinary shares, it comes with a fixed dividend rate, which is paid out to shareholders before dividends are distributed to holders of ordinary shares. Additionally, in the event of liquidation or winding up of the company, preference shares have priority over the ordinary shares, um, in terms of receiving their investment back. However, preference shares typically do not carry voting rights, meaning that the holders of these shares usually do not have any rights to say in the company's decision-making processes. Capital, also known as contributed capital or contributed equity, represent funds contributed to a company by its owners or shareholders, typically in the form of investment in exchange for ownership rights. Donated capital can take various forms, such as cash investment, contribution of assets, or the forgiveness of debts as part of shareholders' equity, and reflects the initial or additional investment made by the owners to finance the company's operation or expansion. For retained earnings, it is referred to the portion of a company's net income that is retained or kept within the business rather than distributed to shareholders as dividends. Essentially, it represents the cumulative profits earned by the company since its inception, minus any dividends paid out to shareholders. Retained earnings are typically reinvested back into the company for various purposes, such as funding growth initiative, paying off debt, acquiring assets, or building up reserve for future needs. They play an important role in the company's financial health and growth, as they provide a source of internal financial for ongoing operations and expansion. For dividend payable, it refers to the amount of money that a company owes to its shareholders as dividends but has not yet paid out. When a company declares dividends, it creates a liability on its balance sheets called dividend payable until the dividends are actually distributed to its shareholders. This means represents the total dividends that the company is obligated to pay to the shareholders, typically based on the number of shares held by its shareholders. So for partnership capital account is an accounting record that tracks each partner's investment in the business. It reflects the amount or money or asset that each partner contributes to the partnership when it is formed, as well as any additional investment made over time. The capital account also includes each partner's share of partnership profits or losses, as well as any withdrawals or distributions taken by the partners. Essentially, it represents each partner's ownership stake in the partnership and is used to determine each partner's share of the partnership's assets and liabilities. So for the last point of the subtopic is proprietorship capital account. So in a sole proprietorship, the business is owned and run by one entire person, known as the sole proprietor. A sole proprietorship is owned by a single individual who makes all the decisions and assumes all the risks and responsibilities of the business. Legally, the business and the owner are considered the same entity. This means that the owner is personally liable for all debts and obligations of the business. Sole proprietorships are often the simplest form of business to establish and operate. They require minimal paperwork and legal formalities compared to other business structures. It is also have complete control over the business and can make decision quickly without having to consult with partners or shareholders.
Assalamualaikum and hi. My name is Jasmine binti Muhammad Rusdi, and I will be the next presenter for the subtopic of methodology for designing tests of balances or liabilities. The methodology for designing tests of balances for capital acquisition and repayment cycle, it is actually the same as other cycles such as sales and collection cycles, payroll cycles, and also inventory cycles. It is actually the same, but the only difference between each of these cycles is actually the name of the account being audited. So, for this methodology in capital acquisition and repayment cycle, we have three phases, which is phase one, phase two, and also phase three. So for phase one, firstly we have to identify the client's business risk affecting the notes payable. So this way, auditors they have to know the business. They have to understand the client's business, the industry, their client's external environment, and also they have to evaluate the management objectives and also the client's business processes. Next, set tolerable misstatements and assess inherent risk for notes payables. So for setting the tolerable misstatement for capital acquisition and repayment cycle, it is actually set at a low level because it is usually possible to completely audit the account balances and the transactions affecting the notes payables account. For inherent risk, it is also at a low level because the correct account value is usually very easy to determine. And for this case, auditors are actually more focused on the completeness objectives for the notes payables account balances and disclosure, such as collateral and also covenant restrictions. And next is to assess control risk for notes payable. So since in the notes payables accounts, they actually contain only a few transactions, so the control risk and the result of substantive tests of transactions are actually less important for the test of details for the test of balances for liabilities. So moving on for phase two, which is design and perform tests of controls and substantive tests of transactions for capital acquisition and repayment cycle. And next is for phase three, which is auditors they have to design and perform analytical procedures for notes payable balance. So this is where auditors they would perform analytical procedures that may indicate any increased risk of misstatement in notes payables. And lastly, they have to design tests of details of notes payable balance to satisfy the balance related to the audit payables. All right, moving on to the next subtopic, which is notes payable. So, notes payable is a legal obligation to a creditor, which may be secured or unsecured by assets and also bears interest. So, in other words, notes payable is actually a promise or a written promise specifically to pay a specific amount of money at a specified future date or on demand. So, here it mentions secured or unsecured assets where secured assets is actually an asset that has collateral, and vice versa, unsecured asset where it has no collateral. So collateral here means it is actually a property or a valuable asset where the borrower offers in order to secure the loan. And next, for notes payables, it is actually issued for a period between 1 month and also 1 year. But also there is also long-term um, notes payables where it exceeds the period of 1 year. And these notes payables are actually issued for very different purposes. And the property pledge as collateral, as mentioned earlier, it includes a wide variety of assets, a wide variety of valuable assets, such as securities, account receivables, inventory, and also fixed asset. And next, the principal and the interest must be met accordance with the terms of loan agreement that has been made. And for the principal and interest payment, they have two types of repayment, which is short-term loan and also for over 90 days. For the repayment for short-term loan, the interest and the principal, it is only required when the loan becomes due. And for over 90 days, the principal and interest payment, they usually calls for monthly or quarterly interest payments. All right, moving on to the next topic, which is the objectives of the audit of notes payable. So there are a total of four objectives of the audit of notes payable, where the first one is the internal control over the notes are adequate. So for the controls in the notes payables, as an example, in terms of repayment of principal and interest of the notes payable, the accounting department, they should receive a copy of the notes payable, and also in accounts payables department, they should automatically issue a check or an electronic fund transfer when the notes payables are due. A copy of the notes payables is extremely important for documentation purposes for payment. And next is the transaction are properly authorized and recorded accordance to the transaction related audit objectives, which is detailed tie-in, existence, completeness, accuracy, classification, cut-off, and also rights. However, out of all the transaction related audit objectives, the only objective that is not included is realizable value. So why realizable value is actually excluded in the objective of audit of notes payable accounts transaction? It is because realizable value is only a concept that is applied to assets, not liabilities, because payable is a liability, not an asset. And for additional information, notes payables are disclosed as liabilities on balance sheet, and for long-term note payables, it is disclosed as long-term liabilities under current liabilities. Next, objective, which is the related liabilities and expenses are properly stated. So this is to ensure or provide assurance on the completeness and also the accuracy of the financial statement. And lastly, the last objective are disclosures related to the notes payable and the related interest expense. They have to satisfy the four presentation and disclosure of audit objectives, which are completeness, accuracy, understandability, and also classification. So, if the disclosures related to the notes payables and their related expenses, they satisfy these four objectives, it indicates that the auditing process has effectively addressed the key aspects of presenting and disclosing the information of notes payable. And these objectives details will be further explained more to the on on the internal controls, which is will be explained on the next presenter. So that is all from me. Thank you.
Hi, my name is Nur Isabella binti Muhammad Azman again. Now I would like to present my other part, which is the internal controls for notes payable. There are four internal controls. Let's start with the first one, which is proper authorization for the new issue of new notes. Responsibility for the issuance of new notes should be vested by the Board of Directors or high-level management personnel. The authority to issue new notes payable should rest with the company's BOD or senior management. This ensures that such significant financial decisions are made by individuals who have comprehensive understanding of the company's strategic goals and financial position. High-level oversight helps mitigate the risk of unauthorized or imprudent borrowing. Two signatures of properly authorized officials. is a requirement for dual signatures for all loan agreements because this adds an extra layer of security and accountability, ensuring that no single individual has unilateral control over the issuance of debt. Typically, the authorized officials would include a senior executive such as the CEO or CFO and another high-ranking officer or board member. Dual signature helps prevent fraud and ensure that the decision to issue new debt has been thoroughly reviewed and approved. Third is the loan agreement details. Loan agreement details should consist of the amount of loan, the interest rate percentage, the repayment terms, and the asset pledged. For the amount, the specific amount of loan should be clearly stated in the loan agreement. This ensures transparency and clarity about the company's new financial obligation. For the interest rate percentage, it should be explicitly outlined. This helps in the understanding the cost of debt over time and facilitates accurate financial planning and reporting. For the repayment terms, detailed repayment terms, including the schedule and duration of payments, should be included because this provides a clear roadmap for fulfilling the debt obligation and helps in cash flow management. And for the assets pledge, if any assets are being pledged as collateral for the loan, this must be clearly identified in the agreement. This ensures that both parties understand the security backing the loan and the potential consequences in case of default. For the summary of this point, proper authorization for issuing new notes payable involves ensuring that the authority to approve such significant financial decision is vested in the company's board of directors or senior management. Requiring dual signatures from authorized officials enhances security and accountability. Additionally, having detailed loan agreements that specify the loan amount, interest rate, repayment terms, and any pledged assets ensures transparency and facilitates proper financial management. These measures collectively help in maintaining the integrity and accuracy of the company's financial dealings and reporting. Second is the adequate control over the repayment of principal and interest. The periodic payment of interest and principal subject to controls in the acquisition and payment cycle. Integration with acquisition and payment control is used for repaying the principal and interest on notes payable, which should align with the company's established acquisition and payment cycle controls. This includes standardized procedures for authorizing, processing, and recording payments. Such integration ensures consistency, which prevents errors and reduces the risk of unauthorized or missed payment. For the accounting department, they should receive a copy of the note when issued. This is for documentation and record keeping. When a note is issued, the accounting department must receive a copy of the note. This documentation includes essential details such as the amount of loan, interest rate, and repayment schedule. Having a copy of the note ensures that the accounting department can accurately record the liability of the financial statements and set out a schedule for future payments. It is also for recording setup. The accounting department will ensure the information from the note to set up records in the accounting system, ensuring that both the principal and interest are tracked correctly. For the accounts payable department, they should issue checks for notes when they are due. This is for scheduled payment. The account payable department is responsible for issuing checks for making electronic payments for notes payable as they come due. This responsibility involves setting up reminder or automated schedules to ensure timely payments for avoiding late fees or default. This requires payment verification. Before issuing this payment, the accounts payable department should verify the amounts due against the records maintained by the accounting department. This cross-checking helps ensure that the payments are accurate and authorized. Authorization and approval. This account payable department should follow established procedures for authorizing and approving payments. Similar to other vendor payments, these include obtaining necessary approvals from authorized personnel before releasing funds. My third point is proper documentation and records. For proper document and records, Reconciliation of blank and paid notes by authorized person is important because blank and paid notes should be periodically reconciled by an authorized person who is independent of handling an issuance process. This involves comparing records of issue, outstanding, and paid notes with the actual physical or electronic notes to ensure all notes are accounted for and there are no discrepancies. For authorized person, the person responsible for this reconciliation should have the appropriate authority and independence to ensure objectivity. This helps prevent potential fraud or errors from going unnoticed. And for the cancellation and retention of paid notes, once a note is paid off, it should be clearly marked as paid or cancelled. This involves stamping the note or marking it with some other definitive way to ensure it cannot be reused fraudulently. The retention under custody of an authorized official is important because it's to retain securely under the custody of an authorized official. This ensures that they are kept in a safe place, protected from unauthorized access or tampering. The authorized official should be someone with appropriate level of responsibility and trustworthiness within the organization. And for the retention period, the retention period for paid notes should comply with the company's document retention policy and any relevant legal or regulatory requirement. Keeping these documents allow for future reference or audits and ensures that there is evidence of the fulfillment of the company's debt obligation. And for the fourth point of the internal control is periodic independent verification. Reconciliation of detailed notes records should be periodically conciled with the general ledger and compared with the notes holders records by an employee who is not responsible for maintaining the detailed records. This is important because this independent employee should also compare the company's records of notes payable with the records maintained by the note holders. This ensures that both parties have consistent and accurate records of the amounts owed and terms of the notes. Any discrepancies between the company's record and the notes holder record should be promptly investigated and resolved. Accurate and consistent records help maintain and ensure financial reporting. And for the computation of interest expense, there should be an independent recomputation of the interest expense on notes to test the accuracy of record keeping. Interest expense calculation is the interest expense on notes payable should be calculated based on principal amount, interest rate, and the period for which interest is owed. The recomputation process is when the independent employee should recompute the interest expense on notes payable to verify the accuracy of the recorded interest expense. This involves using the terms on the notes, principal, interest rate, and time period to independently calculate the interest and compare with the recorded amounts. This is to test accuracy of the company's record keeping. Any errors or discrepancies identified should be corrected to ensure that the financial statements reflect the true interest expense. And that is all for the internal control of the notes payable. Next is the notes payable and the related interest accounts. Let's observe the diagram and I will explain it in detail. First of all, we open 4 accounts, which is the notes payable account, cash in bank account, interest expense account, and interest payable account. So why do we open these 4 accounts? For the notes payable account, it will show the full loan we receive and the amount we need to pay in interest and principal. And for the interest expense account, it will show the total amount we pay for interest on the loan. And for the interest payable, it will show all the accrued interest expense. So when we issue a new note, we will open the first account, which is notes payable. So it will be debit all the expenses, payments of the principal, and credit will be issuance of new notes. Why is it credit? Because this notes is considered a loan, which is a liability. And for the second account, which is cash in bank, when we issue new notes, we receive the money, so it will be debit in cash. But at the credit side, there will be two expenses, which is an outflow, which is the payment of principal of the notes and the payment of interest. So these two will go into the interest expense account and will show all the list the interest expense for each year. But when for example 1 year we don't pay for the interest, the full amount of interest that we should pay, we will have to open an interest payable account which shows all the accrued interest expense for the year. And that is all from me. Thank you very much. Moving on to the next presenter.
My name is Nur Fatiha and I will present test of control and substantive test of transaction. Test of notes payable transaction involves accruing recording of receipt from the notes process and the repayment of principal and interest. TOC assess the design and effectiveness of internal control over notes payable transaction. Strong internal control reduce the risk of error or fraud. If the controls are deemed effective, less substantive testing may be needed. And next, SOT, which is substantive test of transaction, are performing to directly verify the accuracy of recorded transaction. For notes payable, this would involve testing a sample of transaction to ensure they are properly recorded and authorized. Independent verification likely refer to obtaining evidence from external sources such as leader or loan agreement to collaborate the information in the company accounting record. This could involve contacting the bank directly and confirming the loan detail like amount, interest rate, and so on. And next, for analytical procedure for notes payable, analytical procedure involves recalculating the interest expense on the notes payable using an average interest rate and the overall monthly notes payable balance. This is then compared to the amount of interest expense that is reported in the financial statement. And for possible misstatement of interest expense and accrued interest or omission of a notes payable. And next, for analytical procedure for notes payable, analytical procedure compare individual notes outstanding with those of the period year, and possible misstatement is omission or misstatement of a notes payable. And next, compare total balance in note payable interest expense and accrued interest with period year balance. And for possible misstatement of interest expense and accrued interest or notes payable. And let's start by comparing individual notes outstanding with those of the period year. This means looking at each notes payable on the company books and comparing it to the corresponding notes from the previous year. This help identify any notes that are missing from the current year financial statement or any notes that have been added but not properly accounted for. Next, we will compare the total balance in note payable interest expense and accrued interest with the previous year balance. This involves looking at the total amount of the money the company owns on its notes payable as well as the amount of interest expense it has incurred and the amount of interest that has accrued but not yet been paid. By comparing this amount to the previous year, we can identify any significant change that may warrant further investigation. Next, I will present about major balance related audit objective in notes payable. The two most important balance related audit objective in notes payable are: one is completeness, existing note payable are included, and two, accuracy, notes payable in the schedule are accurately recorded. These objectives are vital because a misstatement can be material if even one note is omitted or incorrect. When internal control over notes payable are deficient, auditor may need to perform extended procedure to test for omitted notes payable. For example, the auditor might send confirmation to creditors that have held notes from the client in the past but are not currently included in the notes payable schedule. The auditor might also analyze expense for payment to creditor that are not included in the notes payable schedule and review the meaning of the port of Director meeting for authorized but unrecorded notes. And next is the figure common procedure to test for the completeness objective for notes payable. And next, for owner equity, let me share a bit about a public list company. A public list company is a company that can sell its share to the public. This means that everyone can invest in the company by buying its share. Public list company are required to follow stricter rules and regulation than private list company. This is because they have a larger number of shareholders and are more accountable to the public. Public list companies are generally large and more well-known than private list company. And let's move on to a private list company. Private list company is a company that cannot sell its share to the public. The share of a private list company are typically owned by a small number of people such as the founders, family members or employee. Private list company are not required to follow the same strict rule and regulation as a public list company. Private list company are generally smaller and less well-known than public list company. And for the objective for each is to determine whether internal control over capital share and related dividend are inadequate and owner equity transaction are correctly recorded as defined by the SIG transaction related audit objective. Let me show what is the SIG transaction related audit objective. In one is notes payable in the schedule exit, which is existent, and as existing notes payable are included in the notes payable schedule, which is completeness, and notes payable and accrued interest on the schedule are accurate is a accuracy, and notes payable in the schedule are correctly classified is classification, and notes payable are included in the proper period is a cut-off, and last but not least, the company has an obligation to pay the notes payable is obligation. And for owner equity balance are properly recorded as defined by the 8 balance related audit objective and properly present and disclosed as defined by the 4 presentation and disclosure related audit objective for owner equity account. And for the 8 balance related audit objective is one is accuracy. The amount in the owner equity account should be correct based on underlying transaction, and there should be no error in calculation or data entry. And next, for completeness, all owner equity account are included and no transaction are missing. And next is classification. Transaction are recorded in the appropriate owner equity account according to accounting standards. And next is existence. The owner equity represent actual claim of the owner on the business. There are no fictitious entry or liability discussed as equity. And next, evaluation. Owner equity account are valued appropriately based on relevant accounting principle. And next, is right and obligation. The financial statement clearly defines the right and obligation associated with the owner equity, such as dividend right or voting right. And next is presentation and disclosure. The information about owner equity is presented clearly and all relevant disclosure are made in the financial statement. An auditor will perform various tests to ensure these objectives are met. These tests may involve reviewing such document recalculation and obtaining confirmation from owner.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Azli Farhani binti Abdul Rahman. Thank you to the previous presenter. So I'll continue the presentation on owner's equity and dividend account. So from this slide, we could see that there is an amendment made on the share premium at MFRS. So it should be ignored and not related because it is no longer applicable due to the abolishment according to the Company Act 2016. Okay, moving on to the next slide, which is the information about share premium account according to Section 60 Act 125. Companies Act 1965 has been revised in the year 1973, which is Part 4, Shares, Debentures and Charges, Division 3, about shares. where a company issues shares for which a premium is received by the company, whether in cash or in the form of other valuable consideration, a sum equal to the aggregate amount or value of the premiums on those shares shall be transferred to an account called the share premium account. And the provisions of this Act relating to the reduction of the share capital of a company shall subject to this section apply as if the share premium account will paid up share capital of the company. The share premium account may be applied A. in paying up unissued shares to be issued to members of the company as fully paid bonus shares, B. in paying up in whole or in part the balance unpaid on shares previously issued to the members of the company, C. in the payment of dividends if such dividends are satisfied by the issue of shares to member of the company, D. in the case of a company which carries on insurance business in Malaysia by appropriation or transfer to any statutory fund established and maintained pursuant to any law of Malaysia relating to insurance, E. in writing of, 2. characteristics in writing of, which are the preliminary expenses of the company or the expenses of or the commission or brokerage paid or discount allowed on any duty, fee or tax payable on or in connection with an issue of shares of the company, or in providing for the premium payable on redemption and redeemable preference shares. Okay, next slide is about the 8 key updates of the Companies Act 2016 for Sdn Berhad companies. There are 8 key updates, which are minimum number of directors needed, company incorporation process, proof of company incorporation, execution of documents, adoption of a constitution, about shares, annual general meeting, and also lastly lodgement of annual returns. So the one that we were discussing since just now is about shares. It is stated right there on the Companies Act 2016 that there is no par or nominal value for shares, no share premium account, no capital redemption reserve account, as there is an abolishment in the Companies Act 2016. Moving on to the next slide, it is proper authorization of transaction. Each owner's equity transaction is typically material. Transactions must be approved by the board of directors. Transactions such as the issuance of share capitals, repurchase of capital shares, and also declaration of dividends. There are a few steps for proper authorization that could be taken, such as undergo board approval, legal and regulatory compliance, authorization by senior management, coordination with transfer agent, execution of share issuance, internal audit review, and also external audit confirmation. The next internal controls for owner's equity is proper record keeping. When a company maintains its own records of shares, transactions, and outstanding shares, the internal controls must be adequate to ensure that the actual owners are recognized in the records, the correct amount of dividends is paid to the shareholders, the potential for misappropriation of assets is minimized, and the documents that should be maintained are capital share certificate records, shareholders' capital share master file. The next internal controls is segregation of duties. The first bullet point would be the individual responsible for issuing, transferring, and cancelling share certificates should not have any accounting responsibilities. In auditing firms, this principle ensures that the person handling the physical or electronic certificates of shares does not have any access to the accounting records when these transactions are recorded. Desegregation helps prevent a single individual from being able to both execute and conceal unauthorized transactions. For example, if someone could both issue shares and record them in the books, they could create and hide fraudulent share issuances. Next, the individual responsible for maintaining the detailed shareholders record should be independent of the maintenance of the general ledger control accounts. This separation ensures that the person keeping the detailed records of individual shareholders, such as who owns how many shares, does not also manage the general ledger, where the total number of issued shares is recorded. This independence helps ensure that discrepancies between detailed and summarized records can be identified and investigated. It prevents manipulation of the general ledger to hide unauthorized changes in the shareholders' records. The next bullet point is third, the individual responsible for maintaining the detailed shareholders' records should not also process cash receipts or disbursements. Why? Because by separating these duties, the risk of embezzlement and fraudulent transactions is minimized. If the person maintaining shareholders' records could also handle cash transactions, they might record fictitious transactions or alter any shareholders' records to misappropriate the funds. This segregation of duties help ensure that the detailed records accurately reflect the true financial activities and ownership. Lastly, appropriate segregation of duties should be established among the preparation, recording, signing and mailing of dividend checks. This means different individuals should be involved in each step of the dividend payment process. One person prepares the dividend checks, another records the transaction in the accounting system. A third person signs the checks, and yet another person mails them. This division reduces the risk of fraud, such as issuing unauthorized checks or diverting checks for personal gain. Each step provides a checkpoint where errors or irregularities can be detected. The last internal control is independent internal verification of information in the records. Appoint an independent personnel who does not hold any responsibilities in accounting to review the transaction made by the staff. Next, regular independent review can avoid misstatements of errors or fraud. Besides that, independent internal verification involves the review, comparison, and reconciliation of data prepared by the employees. Verification should be made periodically or on a surprise basis. Verification also should be done by an employee independent of the personnel responsible for the information. Discrepancies and exceptions should be reported to a management level that can take appropriate corrective action. In large companies, independent internal verification is often assigned to internal auditors. Internal auditors are employees of the company who evaluate on a continuous basis the effectiveness of the company's system of internal control, and also they periodically review the activities of departments and individuals to determine whether prescribed internal controls are being followed. Okay, moving on to the next slide. Independent share registrar. Company with listed shares is required to engage an independent shares registrar as a control to prevent the improper issue of share certificates. What is the role of a registrar? The role of a registrar is responsible for maintaining an up-to-date record of who owns securities issued by the company. Next, there are a few examples of share registrar. So I came up with few, which are Boardroom Limited and Tricor, Link Market Services, Broadridge Financial Solutions, American Stock Transfer and Trust Company AST, and the last one is the characteristics of independent registrar would be unbiased and objective, accurate record keeping, and security and confidential. So that's all from me. Thank you. I'll pass to the next presenter.
The audit objective of capital shares and paid-in capital focus on ensuring completeness, accuracy, occurrence, and proper presentation and disclosure. These objectives are crucial for maintaining the integrity and reliability of financial statement. The first objective is completeness, which ensures all capital shares and pay-in capital transactions are included in the financial statements. Auditors perform tests to verify this, such as tracing transaction from the source document to the ledger. The second objective is accuracy, which focuses on correct recording of capital shares and paid-in capital amounts. Auditors verify this calculation with supporting documents to confirm accuracy. The third objective is occurrence and accuracy, verifying that transactions recorded occur and pertain to the company. The final objective is presentation and disclosure, ensuring that capital shares and paid-in capital are properly presented and all required disclosures are made. So the next slide is dividends are a crucial part of shareholder returns, and auditing them ensures the accuracy and the integrity of financial reporting. The main audit objective related to dividends are occurrence, completeness, and accuracy. Occurrence involves verifying that dividends recorded in financial statements occur, verifying that dividends were paid to actual shareholders, and ensuring that dividends were not paid to fictitious shareholders. Completeness involves recording all existing dividends in the financial statements, including dividends payable, and ensuring that declared but not yet paid dividends are recorded as liabilities. Accuracy involves verifying the amounts and timing of recorded dividends, preventing errors that could mislead the stakeholders about the company's financial health. So, retained earnings are actually a very crucial part of company's financial health, representing the total profit accumulated over time after dividends are paid to shareholders. And audit retained earnings ensure accurate accounting records, providing investors and creditors with a clear view of the company's financial performance and identifying potential errors or fraud. The transactions that affect retained earnings include net earnings for the year, dividends declared, prior period errors, and prior period adjustment, and also appropriation of retained earnings. Audits are essential for ensuring accurate financial statements and a fair view of a company's financial health.